Welcome to our video market update. I'm Grant, this is Gary. Adam is our third partner, and we are Dynamic Wealth Management. We are grateful for our clients. They came out to our client appreciation event. We had a party just a couple weeks ago where we had some barbecue, and we did it down here in our parking lot. We had a good turnout from our clients, so we were happy to see that. If you didn't make it, we do plan to do more client appreciation events going forward, so look out for an email about that in the future. It has been an exciting time since we did our last video. We had the Super Bowl come out. That was pretty exciting. Most people were expecting the Patriots to win, but they were definitely upset by the Eagles, and that was a real surprise to most of us. And speaking of surprises...
Yeah, speaking of surprises, it looks like volatility has finally found us in the market. We've gone a long time without any type of major pullback at all. Looks like we're finally getting some volatility, but still a lot of good news to be had, and we'll give you the details on how we view that and what action we are taking. And let's go ahead and jump into the charts for you. Good to be with you folks. Again, we're Dynamic Wealth Management, and this is our update of the markets for February 8th. It is Thursday. I want to start out by just giving you a quick update. If you'd like to come and see us in person, these are the couple events that we have coming up. We call these events Investments for Breakfast, and that is where here in our conference room at 9 a.m. we give some more information about the markets, the economy, interest rates. We have good discussions. We talk about strategy, and as well as we provide some donuts, pastries, and some juice, coffee, things like that. We'd love to have you. The next one is next Tuesday, February 13th, and then we do it every 2 weeks, so the one after that would be February 27th. So go ahead and give us a call. It says to reserve your seat, but no need to do that. You can just show up on the day as well, and we'd love to have you. So I want to give you a quick update of what we're going to share in this video, maybe 4 key points. The first one is, since last we talked to you, one of the major things that's driving the markets and what they're seeing right now is we did have major tax reform that was passed by the Congress, and a few key things that we'll touch on, but one of those is the idea that the corporate tax rate dropped substantially from about 35% to 21% for major companies, and that could definitely lead to faster growth and higher earnings for companies, and that could spur the economy even further and maybe cause more inflation as well, and that's what the markets are seeing. Another thing is we continue to see, and we'll see the recent jobs report for the month, continues to show that unemployment is continuing to improve. And in fact, we had an uptick in what we call wage growth, which we'll look at. Again, the markets interpreted that to mean higher inflation there as well. Also, comments from the Fed recently in their last meeting right at the end of last year, or the end of last month, I should say, pointed to higher short-term rates, and we'll touch on that here. It's widely expected, at least the Fed has said, that they'll raise short-term rates 3 times this year in 2018. And of course, the big news is that the stock market is finally showing some volatility. We haven't had really any substantial pullbacks over the last 2 years, coupled with the fact that we've had some really strong upward price action. So basically, those two things come together to finally say, okay, well, it's time for a pullback, right? We had been talking about it for some time, and pullbacks are not necessarily a bad thing. If rates kept going, or if prices kept going up substantially at a very strong clip, then prices would be so high that obviously no one could afford anything. So some pullbacks in a capitalist society that's just the normal part of what markets do. So we'll touch on that. So first of all, I'll get into the economy, and I'll let Grant talk about the stock market and go through some charts as far as key things going on there. First of all, let's talk about the tax changes. This was the Tax Cuts and Jobs Act that came out. We had a presentation on this in our office about a month ago. So this is just the highlights. We're not going to go through all the major changes because there were many. But if we look at this chart, which shows some of the major highlights, we're looking at the current system on this side of things, and over here it's the new legislation that came through. So if we look at for individuals and look at income tax brackets, right, the marginal income tax brackets, what we can easily see there is across every major level of income, you can see there was an improvement. For example, here from 15% to 12, 25 to 22, and all the way down on both sides. So you can definitely see that individuals are widely expected to save money on taxes, right? Another major change is on estate tax, which was already quite high as far as the exemption being at 5.6 per individual. That has doubled. So unless you have assets well above 10 million, excuse me, estate tax probably is not going to be a concern for you. And then, of course, as far as business changes, again, you can see the corporate rate going from 35 to 21, which should make companies much more competitive across the globe and should spur on earnings. But small and medium-sized companies as well, what we call the pass-through business taxes, that would be your sole proprietorships, your partnerships, your S-corps. They are being given a 20% deduction right off the bat as well. So those are major changes which have the potential, obviously, to get more money in the hands of individuals and companies. And the idea is that with more money in their pockets, they would put that to work in the economy and potentially would cause prices to go up and would create some inflation there as well. Speaking of more money in the economy, our jobs report that came in on February 2nd also showed some key things that we wanted to point out. First of all, there were 200,000 jobs that were created, which was about in line with expectations, but definitely on the higher side of the range. Unemployment rate is now as low as 4.1. You can see by the chart below that unemployment over the last several years has continued to come down. But here's the thing that kind of surprised the markets a little bit, and that was the average, what they call the average hourly earnings rate. And this is the year-over-year change, came in at 2.9%. And basically that just represents the rate at which companies are willing to pay their employees on an hourly basis, which is going up. And why is that a significant stat? Is because that is the highest increase we've seen really since the recovery started back in 2009. And again, what that means is that if people are willing to pay more, then basically that would also point to inflation in the job sector that would translate to inflation in basically the economy overall also. Another major thing that I think the markets are watching recently over the last couple weeks is the Fed met on right at the end of the year. I'm sorry, at the end of last month. And even though they kept short-term rates at bay, which the target rate for the federal funds rate is between 1.25 and 1.5, what they did say is they were expecting that the target rate of inflation, which is about 2%, would increase, or that inflation would increase this year to at least 2%. And so because of the change of verbiage in their commentary, again, the markets are widely believing that in their next meeting, which will take place March 21st, that they will more than likely raise short-term rates again by about 1/4 point, and that more than likely they'll raise at least 2 more times throughout the year. By the way, we also do have, going forward now, a new Fed chairman, which is Mr. Powell, and he will be taking the place of Janet Yellen. So all of those things do point to potentially higher inflation, and that's kind of what the market is keen on. Definitely bonds have been reacting over the last several months to the potential for higher inflation. So I'll go ahead and stop here and turn the time over to Grant, and he'll talk about the stock market and give you some more information on what is going on there.
All right. Well, this is the part of the video that you've all been waiting for. So let's jump into the stock market and let's go through some of the stock charts and see if we can get you up to date on what's really happening out there. Okay, here is the S&P 500. Sure enough, we all have known that, man, the last year has been great until just recently. And actually, if you look at, here is where 2018 starts. Wow, look at that January. That was just unbelievable. Straight up parabolic. We knew it couldn't be sustained, right? And sure enough, it turns. And now February has been pretty ugly for us, just the beginning. Depending on which indice you're talking about, the overall large stock indices are down somewhere between 7 and 11%. On this pullback here. The S&P 500 is down around 8%. So it has been a decent little pullback, but look at this. When we throw in a trend line, which gives us a good estimate of where the stock market really should be, is look at this trend line. The S&P 500 was bumping along it and then pulled away from it, and pulled away so strongly that really a lot of us have been saying for a long time that we needed some kind of a pullback. So look, we're pulling back, and not only are we not starting a downtrend yet, we're actually not even back to our trend line. So it has a cushion before it can even get back to our trend line. So it kind of gives us an idea of, okay, this is a normal pullback. Could it keep going? Yes, but the truth is there's nothing to be worried about just yet because we haven't even broke the trend at this point. All right, here's the S&P 500 over the last 4 years. And again, you can notice we follow these trend lines, right? So it was trending up until 2015, then it trended sideways and down just a little bit. And then 2016, it picked up in February and really has been running in this uptrend ever since. And look, recently we actually broke the upper channel of this trend and we just pulled right back into the middle of it. So again, because of how parabolic the stocks have moved recently, this is kind of a way for us to pull back into some kind of a normal range, which is healthy. Speaking of these pullbacks, right? Well, we normally have a couple of 5% pullbacks a year. Well, interestingly enough, we haven't had one since the summer of 2016. So, man, that's a year and a half that we haven't had one. And then sure enough, we just barely had one. So again, we were due for some kind of volatility like this. It's been even longer since we had a 10% pullback. The last 10% pullback was in January of 2016, so about exactly 2 years ago. And again, depending on which indice we're talking about, this is a 10% pullback. It's more than 10% in the Dow. So we'll count this as a 10% pullback so far. But again, normal, right? I mean, man, we have had a nice long run without one. So kind of good to get a bit of a pullback here. Here's some good news. This gives us a good idea of when the market is oversold or overbought. Right now, this is showing an oversold indicator on the McClellan oscillator. What that means is if you look back in history, other times that it was oversold, well, that corresponded with at least a short-term buying opportunity. So right there was a good time to buy, right there was a good time to buy, right there was a good time to buy, and it's telling us it's a good time to buy again, at least on the short term. Now again, this could be the beginning of something bigger, which if it is, we're totally prepared for that. But at least on the short term, this looks like a opportunity to buy a pullback. Here are interest rates. I think we all know interest rates have been coming up, especially recently. So since September of 2017, interest rates have been coming up. And what does that do? That hurts bonds and actually doesn't help stocks either. But you'll notice that this has kind of been pressuring things to the downside. As interest rates go up, it kind of puts a headwind on stocks and it really hurts bond prices. So we'll demonstrate that here. So recently, since this drop has started, you'll notice stocks have been coming down, commodities have been coming down, and actually even the dollar and bonds have been coming down. So there really hasn't been a place to run. I mean, bonds have gone down less than stocks in this downturn here. Now, the one place that does still look pretty good out there when the market goes bad is treasuries. And that's where we will move more to safety. If the market continues to crash, we would pick up more treasury positions. Okay, here are all of the major sectors year to date. So if you jump out there, you'll notice, well, this is really the major markets. Technology is still up year to date, even after this big drop. The S&P 500 is flat. Small caps down a little bit. Dollar down a little bit. REITs are down quite a bit, but we knew that. REITs have been underperforming for a long time. Gold kind of holding up in there, doing pretty well. But overall, I mean, these are year-to-date numbers. It's not bad. We gained quite a bit in January, and we've given a lot of it back now to kind of be flat for the year. If we look at the last 6 months, though, the last 6 months still look great. S&P 500, even after this big drop, is up 9%. NASDAQ's up 11%. Small caps are up. International is up. Commodities are up. Dollar's down a bit. And the REITs, of course, like we said, REITs have been down for a while. That's why we don't hold them. Gold is up. High yield flat. And the 10-year treasury down a little bit. Here's our model allocations. For those of you who have watched our videos before, you know what this is. So this is kind of our indicator, as it shows us which zone that we're in. So right now we are still in the upper zone, because we're above this yellow line, which is our bullish green zone. You'll notice because of this parabolic move, we actually got quite a bit, we created some distance between us and this yellow line. So we actually still have some cushion here. And that's good because, again, as a lot of the indicators show, this is most likely an opportunity to buy. So we're glad that we're not being forced out of the market here. Now, this could be the beginning of something worse, and if that's true, then when we hit this yellow line, we'll start taking our clients to safety and getting out of the way. So we do have a plan, obviously, to protect our clients, but we still have some cushion before we need to do that. Again, just another indicator that how we show it. We are in the green bullish zone. What does that mean? That means that if you are in our ETF core model, you're in one of these allocations. You're either 100% in if you're a growth client, you're 80% in if you're a moderate client and 20% defensive. And if you're a conservative client, you are 60% in and 40% defensive. So depending on which one of the models you're in, you participated in all those gains, but also our growth clients have felt 100% of this recent pullback, where our conservative clients only felt 60% of this recent pullback. So that's why the models exist that way. Here's our sector rotation model. Again, we try to grab the best half of the market and leave out the losers. And you'll notice real estate has been underperforming and is towards the bottom of our list. One thing that we'll quickly note is that we don't just want to buy the best things. We want to buy the things that are doing well, but doing well with low volatility. You'll notice biotech is way at the bottom of our list. And actually, it's been a pretty good performer, but it's been very volatile. And because of its volatility, we lower it down our ranking. We don't want something that is drastically volatile like that. But these are our holdings in our sector rotation model as of January 1, 2018, which obviously tends to do pretty well as we are trying to grab the best trending sectors out there. All right, that's our video, guys. Please reach out to us with any questions that you have. Of course, as always, we are not making any recommendations to anyone or selling anything. We are just simply educating you on what we see out there and sharing our opinions. Do not make any financial decisions based on this video. Please consult your financial professional. Thanks for watching. We'll put out another video soon.